This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Christine Lagarde warns interest rates may rise after a potential pause. We're going to get a fresh read on growth and inflation in moments as Lagarde stresses that decisions from here will depend on data. Another surprise from the Bank of Japan. The BOJ holds an unscheduled bond buying operation to tamp down rates after tweaking policy last week. And China's economic activity lost more steam in July, with manufacturing contracting again and services weakening. Beijing promises more support to boost consumption. Welcome to Bloomberg Surveillance. This is the early edition. I'm Dani Berger in London. Kriti Gupta is in New York. Kriti, are you ready? Are you ready for another crazy busy week? I think we've got $11 trillion worth of U.S. stocks that are going to report earnings.
Yeah, it doesn't exactly stop, and it really kind of runs the gambit in terms of the sectors that are getting covered. But Dani, that does seem like a rest of the week story when you look at what the markets are doing this morning, because right now, not much of anything. Take a look at futures. S&P 500 futures really trading mostly unchanged, 46.10 on those contracts. It is important to keep in mind, though, that it is staying above that round number of 4,600. So we are going to really explore in the show what that means for the future of the stock market. The bond market gets a little interesting, too, especially given the news overnight coming out of the BOJ. The market perhaps testing that BOJ policy. What is kind of yield curve control in the face of inflation that just won't stop? We're going to dive into that as well. Right now, though, you aren't seeing a ton of read-through into the bond market, at least stateside. The 10-year yield at about 3.98, we'll call it, only higher by about 3 basis points. So really, again, nothing to write home about just yet, but certainly something that could be moving as, of course, perhaps we digest some of the data crossing the wire in just a moment. We'll get to that. The dollar yen story is also significant. You are continuing to see some weakness in the yen. 142.42 on that currency pair, stronger in the greenback by about 0.9%. Again, major story overnight. We're going to dive into the details shortly. And NYMEX crude trading, Dani, with an 80 handle, higher by just 0.2%.
Kriti, we're just getting euro area CPI figures coming through. It's bad news when it comes to core. Core coming in at 5.5%. The expectation was for 5.4. This has been the sticky area. Let me run you through the numbers. Second quarter GDP. We've also got that for the euro area. That is stronger than expected, 0.3% quarter over quarter. The estimate was for 0.2%. Euro area July CPI, 5.3% when it comes to the headline. That is in line with estimates. Again, though, it is the core that is concerning. July core CPI has come in at 5.5%. The estimate was for 5.3. Had it 5.4 rather, had it fallen to 5.3, it would have been the lowest since Jan 2022. But it is hotter than expected. Good news for Italy, however, that CPI just hit. That is 6.4% year over year. The estimate was for 6.5. So overall, core continues to be a problem. It is still too sticky. We've had the immediate reaction in the euro versus the dollar was mostly flat. Now it's strengthening about 0.1%. It trades above 110. The bond story, we've been selling off for most of the morning, really tracking the U.S. Both UK and German 10-year yields up by about 3 basis points. European stocks, now they've moved to little change. We've been waffling back and forth between that, really struggling to find any direction as the earnings figures hit. There's some bad consumer news with Heineken, but it is these eco numbers that are going to be the thing that can possibly shake things up today. Again, Lagarde had been saying, she was speaking to El Figaro, that potentially after September pause, they can go again. Can they pause, though, if the core number is coming in stickier than expected? On this, let's get over to Bloomberg's Jana Randau, who covers the ECB and economics in Frankfurt. Jana, let's start with these CPI figures and the GDP. What stands out to you?
Well, certainly on the surface, the reports have some encouraging information. The economy is holding up better than expected, slightly stronger than expected growth. Headline inflation is coming down. But if you look under the surface, then those data really spell trouble. We have contractions now in Italy, in Austria, in Latvia. The economies of Germany and Portugal are stagnating. So that tells you that in past interest rate increases by the European Central Bank are starting to show some effect. And the hope is that this will ultimately also show up in inflation figures. So far on the domestic side of inflation, we're not seeing that very much. Now, if you're a central banker, of course, then you're looking at these numbers, trying to figure out what are we going to do in September? Are we going to hike again? Are we maybe pausing to see how that past tightening will continue to filter through. And to be perfectly honest, there is no straightforward answer, not out of the reports that we've received just now. They probably want to wait, until the end of August, when new data come in. In the start of September, again, more data arrives, and I think we'll just have to be a bit patient to see how the economy develops. Certainly, we are starting to see the impact of the past ECB rate hikes.
Yeah.
But for now, it really looks grim.
Yeah, it seems like it. Jana, talk to us a little bit again about what that does mean for perhaps the recession that a lot of the market forecasted at the end of last year. Is that still on the horizon, or is this perhaps an environment, a soft landing that we can navigate very quickly, Jana?
It's interesting. I think the outlook is going to deteriorate. We're seeing it in manufacturing, or have seen it for a very long time. Services now are slowing as well. One interesting report that caught my attention in the morning is that one by AXA's chief economist, Gilles Mouek, who said, he's afraid of a hardish landing for the Eurozone now. Soft landing seems to be off the chart for him. And I think that is certainly a risk that we need to watch out for. So outlook getting worse, economy is slowing. Watch this space.
Jana, thank you very much. Bloomberg's Jana Randau watching the space for us, reporting from Frankfurt. And we actually had more surprises from central banks, from the BOJ specifically. It announced an unscheduled bond buying operation to tamp down rates after adjusting policy last week. Joining us now on this is Bloomberg's Valerie Teitel. Valerie, what does this tell us about what is acceptable for the BOJ, about when they will step into this market?
Look, it's the first hint at what might be a trigger. We had a 5 basis point move in the 10-year JGB overnight, which doesn't sound like a lot when you look at other markets, but for the Japanese market, it is quite a substantial move. They stepped in right as we got over 60 basis points. So was it a yield level, or was it the 5 basis point move? We have really yet to figure out. That is just necessarily the first hint we're getting on the BOJ's reaction function. What is their definition of flexible? What is their definition of nimble? And when maybe will their firepower be tested? A lot of chat out there in the markets that's saying we need some strong U.S. economic data to really push Treasury yields higher, to then see what the Bank of Japan does if we maybe perhaps get a 10 basis point move, let's say, on JGB yields overnight. That's going to be the real test. And maybe we get that Wednesday or Thursday. We get ISM manufacturing data out this week from the U.S. ahead of the payrolls on Friday. So that'll be interesting to see how they're stress tested on that first real strong U.S. data.
Valerie, explain the divergence here we're seeing between the bond market and the currency market. You would think if yields are higher, the yen would strengthen as well. But today, even last week, we didn't exactly see that. Why is that?
Substantial weakness in the yen today. I think it's catching many by surprise, Kriti. I'll explain it to you simply. Perhaps this yield move, this tweak by the BOJ and YCC will be enough tightening for them in order to push back any hopes of a tightening cycle. The real thing that's going to strengthen the yen would be a hint from the BOJ that they intend to raise rates sometime soon. And if you look at it in the perspective of this tweak, maybe doing enough tightening for them, bringing down inflation slightly just for them, maybe they don't need to hike in anytime soon, and they're going to completely miss this tightening cycle. As we know, many other central banks out there looking at a pause, and cuts are on the table. So if they don't hike anytime soon, they're really likely to miss this cycle all the way around.
Valerie, thank you so much. That's Bloomberg's Valerie Teitel with the latest on the BOJ. Now, elsewhere in Asia, China is seeking to boost consumption to spur the economy's recovery, although the government has stopped short of providing direct fiscal support to consumers and companies to increase spending. The vice chair of China National Development and Reform Commission spoke at a press conference earlier.
The momentum of some consumer goods is still not solid. Some consumers lack confidence and have many concerns. And the consumer experience in some areas is not good. All this requires further policy stimulus. According to decisions of the CPC Central Committee and the State Council, the NDRC, together with other relevant departments, have conducted in-depth analysis and plans to formulate a series of policy to promote consumption recovery.
Joining us now on this is Bloomberg China economy and government editor Jill Desis. Jill, the measures seem to stop short of actually handing consumers checks, of getting spending going that way. The market seems to like it. Hong Kong stocks rallied today. Is this a step in the right direction of what investors want to see to stimulate consumption?
Hey, Dani. Yeah, so look, I think at this point, investors are really just clinging to any news of any kind of stimulus or support that they can get out of Beijing. I think what this showed us today, leading on the back of those Politburo statements from last week, so that's when the top governing body got together to talk about move the economy forward and get growth back on track. What we ultimately saw out of that meeting was this idea of taking more of a pro-growth stance. While there may not be any massive stimulus measures, the government did indicate that they would do some of these smaller level measures to address some of the problems within the economy. I think that's exactly what you're seeing today. So what we saw, as you just saw out of this consumption meeting, this meeting with the NDRC, is they're getting together and they're saying, you know, maybe there's ways that we can ease some restrictions on car purchases. They talked a bit about some other ways to get things going again. Nothing massive on the demand side there. Of course, as you noticed, I don't really know that consumption checks are in the works right now, but it is at least a signal to the market, to economists that, like, yes, they know that growth is slowing down and they want to be able to get things back on track in a way that China sees as possible for them within the constraints that they have in terms of, you know, local debt and all these other kinds of things that are maybe constraining their ability to do massive stimulus.
Jill, how long is too long when it comes to stimulus? Of course, we know that one of the criticisms of the Federal Reserve is they were stimulative for too long. When does that apply to the PBOC and the Chinese Communist Party?
Right. Well, I think at this point, I mean, it wouldn't surprise me if, you know, China's looking back at the last couple of years of how, stimulus during the pandemic was handled in Western nations and kind of seeing some of the issues with inflation there. But ultimately, I think the thing about stimulus in China is that there are some of those big constraints that the government feels is, you know, preventing them from doing anything more. I mean, the local government debt issue is a pretty massive one within China. They're really wary of how much they're adding to those balance sheets right there. I think that at this point, that idea of no massive stimulus has really taken hold within the government, because they're sitting there saying, we think that, you know, we can be a bit more constrained or reserved in our approach. How well they're at performing that, we'll have to see. I mean, I'll point out that the data today didn't look that great if you look at some of the official headline PMIs, but that still captures a period in July from before this Politburo meeting happened and before we started to see these additional measures. So we'll have to see going forward whether there's an improvement, especially in household and business confidence with some of these new measures as we get into the third quarter of the year more fully.
Yeah, PMIs, contraction manufacturing, slowdown in services, but as you say, by its very nature, it is backwards looking. Jill, thanks so much. Bloomberg's Jill Desis there. Now, coming up on the show with Kriti and me, we're going to catch up with Matt Maley, Miller Tabak Chief Market Strategist, later in the hour. And Heineken, it cut its earnings forecast on weakening consumption. We're going to hear from the Dutch brewer CEO later in the hour.
The real relief will start to come into next year. We have increasing visibility on our input costs for next year, and we see a lot of favorability there, which really makes us confident in the acceleration of the performance going into 24. For the remainder of this year, it will be better, but there's still some significant cost flowing through the P&L.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Look, the BOJ continues to be a story, even though we have tons of macroeconomic events and earnings on the docket this week. Nevertheless, Japan seems to take the cake anyway when we're talking about what happened overnight. Look, last week they tweaked their yield curve control to allow yields up to 1%. And then today, or at least overnight, you see the BOJ stepping into the bond market, trying to tamper down those very yields. Does it work? Well, to our radio audience, stick with me. We're basically looking at a chart of those JGB yields, and the answer is very quickly, no, it does not work, because you are still seeing those yields tick higher and higher. The question is, what does the BOJ do next, especially when you are still seeing inflation also tick higher and higher? Let's bring in a true expert. Bloomberg macro strategist Simon White joins us now. Simon, explain to me what the read-through is for the rest of the world, given that Japan, at the end of the day, is a creditor nation. If you see the BOJ continue to step into the market like this, at what point do you start to see funds exit all the other bond markets in the world and go home?
Yeah, I mean, it's, as you say, it's huge importance for the rest of the world. Japan, net creditor nation, so therefore it's not so much about capital flows into Japan that is really important, it's about capital flows going out of Japan. So what was kind of interesting after the announcement on Friday was you saw some steepening of the US yield curve plus the UK yield curve, European curves. And that's maybe at the margin, you're seeing some capital maybe returning to Japan because you've now got slightly higher 10-year yields. So maybe people are getting out of, say, US positions. So they're having to sell their 10-year, but they're unwinding the funding leg as well. So that causes a steepening in the yield curve. But look, the bigger picture is, I mean, if you compared to like last week, I mean, US 10-year yields and JGB 10-year yields are up about roughly the same amount. So the yield differentials haven't really changed that much. And for Japanese investors, it's still, once you take account of the FX hedging costs, it's still a very poor proposition to go buy 10-year debt. So that hasn't really, in that sense, massively moved the needle. You're not, there's no real reason you can see for a big change in capital flows right now.
Is that pretty much why the yen has remained weak? I mean, it's weaker even still today, weaker than it was on Wednesday.
Yeah, I mean, if you look at the net, I mean, the Bank of Japan has a capacity to surprise for sure, but not really to shock, because the dollar yen is only marginally higher than where it was, say, last week. Right. And I think a lot of that is two-way flows. There's been a lot of volatility, because if you have like people unwinding funding legs, that's yen one way, coming back and selling your 10-year debt, that's yen another way. So there's probably been a lot of two-way flows, which is why I've seen the volatility. But the net move so far is very small, because, as I say, the yield differentials haven't massively changed. So there's no real big reason for capital to come back to Japan now. The yields have not risen that much in comparison to what's been happening in the US.
Right. I mean, it seems like that chop is just going to continue again if the band is now wider. Markets potentially have the...
Well, they're going to keep testing them, of course.
Exactly.
So that's the next thing. But yeah, I think the volatility is the thing for now. But this is not a sea change quite yet.
All right, Simon, thank you so much for joining. As always, that's Bloomberg MLive, Simon White. And for more market analysis from Simon and the team, MLive Go is where you want to head on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Dani Berger in London. Russia has blamed Ukraine for drone attacks on its capital that damaged 2 Moscow city office towers and prompted the temporary closure of one of the city's international airports over the weekend. Bloomberg's news director for Europe, the Middle East and Africa, Rosalind Matheson, joins us now. Roz, what did these attacks say about the state of the war in Ukraine? Is it still on Ukrainian turf, or has it shifted to Russia?
Well, there's very much a counteroffensive still going on the ground in Ukraine. Kiev's forces are pushing back in the south and the east of the country, although it is very slow going. And what we're seeing is an escalation in air attacks as a result. We're seeing Russia use missile strikes on Black Sea ports in particular, trying to hit grain infrastructure, trying to penalize Ukraine economically, and most recently today hitting President Volodymyr Zelensky's hometown also. And in turn, what you're seeing is Ukrainian supporters, because Ukraine very rarely claims credit for these things directly, carrying out attacks, drone attacks on Russian soil, and in fact possibly even missile attacks on parts of Russian soil. So you've seen that pick up. Certainly the number of drones that are coming into Moscow or the greater Moscow area are picking up. But interestingly, in all of this, the thing that really seems to rile the Russian president, Vladimir Putin, is not these attacks on Moscow or inside Russian territory, but it's when Ukraine goes for Crimea, of course, which he annexed almost a decade ago. And that's where we tend to see Russia retaliating.
There's still efforts for peace talks, this time through Saudi. Zelensky's chief of staff saying that they would host a meeting soon with national security and political advisors. What does it mean to have this hosted on Saudi Arabia's soil?
Well, it's very interesting that Saudi Arabia seems to be doing the running here. These are not actually going to be peace talks. There's not a peace negotiation at this point in time. What they are is trying to bring in a collection of nations to talk about security guarantees for Ukraine at whatever point in the future there is no longer a conflict going on. What we know is that Ukraine's allies in Europe and the US have already signed up for bilateral security guarantees for Ukraine. What they want is many other countries to join in. So we're talking India, Brazil, possibly even China, Turkey, bringing bringing those countries into the tent on that. So this is a conversation about a really big umbrella of security guarantees for Ukraine, hopefully to sort of point in the direction of peace talks, but no peace talks happening yet.
Rosalind, in our kind of last minute here, where does the U.S. fall in all this? Are they clearly not brokering the negotiations, but where is their kind of say? Of course, we know they support Ukraine, but where does the country really fall in terms of being a part of this process?
Well, certainly one of the biggest allies of Ukraine throughout since Russia's invasion, supporting it militarily, financially, diplomatically, and being a real advocate for Ukraine on the ground. The interesting thing is, at what point does that US narrative start to shift? Do they start to push Zelensky towards having negotiations? Because, they've been the one really that Zelensky is potentially listening to the most. So as we get into the US election cycle, which could create some difficulty at home in these conversations, do you start to see the US saying this war's gone on for 18 months or 2 years or whatever? We need to get to the point of negotiation. That's the narrative that's going to be really interesting to watch.
Right, and a lot of the world will be in an election cycle, so that's certainly an interesting dynamic. Roz, thank you so much, as always, for joining us. That's Bloomberg's Rosalind Matheson. Now, coming up, we'll get back to the equity story and speak to Matt Maley, Miller Tabak Chief Market Strategist, next, as Asia stocks hit a new high for the year and S&P 500 stocks inch ever closer to yet another high for the year. All of that is to come on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Christine Lagarde warns interest rates may rise after a potential pause. The latest data out of Europe earlier this hour, though, adds more weight to possible bets to pause for the ECB in September. And another surprise from the Bank of Japan. The BOJ holds an unscheduled bond buying operation to tamp down rates after tweaking policy last week. And China's economic activity lost more steam in July, with manufacturing contracting yet again and services weakening. Beijing promises more support to boost consumption. I'm Kriti Gupta in New York with Dani Berger in London. Dani, from central bank to central bank, the conversation is still the same. Do we follow the Federal Reserve's lead in potentially pausing in the next meeting?
I heard some really biting words from a hedge fund manager who compared the ECB to a regional Fed, which I'm sure Christine Lagarde would hate to hear that. But it is to some degree true. When you look at what the Fed is doing, does the ECB have to follow suit? We're also going to get a BOE decision this week, too. In the meantime, we're looking at earnings. We're mostly trading on that. We are in a little bit of an eye in the middle of a storm in terms of all this central bank and earnings data we're going to be getting. Really, the only big earnings story we had in Europe was Heineken, which disappointed. But overall, European equities able to climb about 0.2%. Both UK yields and Germany yields are moving higher. The data we had about 30 minutes ago did show CPI coming in line with expectations on a headline basis, 5.3%. Core was slightly more sticky than expected, 5.5. The estimate was for 5.4. Even so, we're not making too big of a deal of that in terms of the ECB needing to hike in September. They certainly don't want to broadcast that. So euro is stronger, though, off the back of that, currently trading at 110, Kriti.
Yeah, an interesting dynamic that you're seeing in Europe, though, because in the U.S., you're not seeing any dynamic yet at all. No real direction when it comes to the markets. Direction this morning, the S&P 500 really, again, when you look at futures contracts, virtually unchanged. 46.10 on those contracts at the moment. Does that change, though, throughout the week, of course, as we get those earnings stories and, of course, the macroeconomic picture changes as well, which brings us to the bond market. The 10-year yield, you would think, would show a little bit more sensitivity, perhaps, to what we heard overnight from the BOJ, essentially stepping into the bond market. Well, not so much. 398 on on those notes, I should say, higher by about 3 basis points. And I would argue taking the dollar with it, because you are seeing some real weakness in the Japanese yen, not really matching that massive rise in yield you saw overnight. Nevertheless, dollar yen stronger by about 0.8%, 142.27 on that currency pair. Dani, our obligatory check on the commodity space, of course, NYMEX crude inching higher and higher as well. Of course, a lot of it coming as a function of risk sentiment, trading at about $80 a handle.
Yay, above 80. Good news for oil. All right, let's talk more about risk appetite, because it has been voracious. And we know that's been trouble for the bears out there, Morgan Stanley's Mike Wilson being one of them. I want to point out this new note he's recently written. He says that this rally is like 2019, saying, quote, the data we have today suggests that we are in a policy-driven late cycle rally. These developments fostered a robust rally in equities. He's talking about 2019 here. That was driven almost entirely by multiple and not earnings. And that's been the case this year. He goes on to say he needs to see more evidence to suggest that this would be anything like an early cycle rally. Joining us now is Matt Maley, Chief Market Strategist at Miller Tabak. Matt, this is a comparison you've made before, too, to this market looking like 2019. First, why? And second, is that a good thing?
Well, it's not necessarily a great thing. And one of the reasons, I mean, multiple expansion is not something that creates. It doesn't cause the stock market to move higher. Something else causes it to move higher. And when it gets more expensive, that can cause problems down the road. Back in 2019, it was the liquidity injection we got from the Fed with their QE. They kept I used to call it a QE, not QE program, because they kept saying it wasn't QE, but it was because of the repo crisis. This time around, it was the Silicon Valley Bank and the regional banking crisis, where the Fed injected liquidity into the system last spring. Those are the reasons the market moved higher, not because earnings were expanding or not because the economy was really growing. So at some point, I'm afraid the chickens will have to come home to roost. But thankfully, it shouldn't be. Hopefully, it'd be like what happened in 2020 when we had a pandemic and the market went down 35%. But it still should cause some headwinds at some point once that liquidity becomes less plentiful.
I guess this is the thing. What ended that in 2019 was COVID. And as we talked about during the break, Matt, we all hope and pray that that's not what ends up ending the rally this time around. But is that what it requires to end a rally based off multiple expansion? You need some sort of exogenous shock.
Well, I mean, one of the things, maybe it's a shock, as you say, you worry that the Fed keeps interest rates higher, whether they raise them anymore or not, but they keep them higher. Does that cause another sort of something to break, as they say? Last time it wasn't the Fed causing something to break. Obviously, it was this exogenous event. But at some point, people start to look around and say, hey, interest rate, our interest rates, I guess my biggest thing is that one thing that people forget about what happens with the Fed raising interest rates, part of their the reason why they did it was, obviously number one was because of inflation, but number two is they needed to normalize interest rates. And interest rates were abnormally low, down at zero, and therefore they were going to raise them whether we had inflation or not. They just had to raise them a lot more. My point is that if and when they come back down, they're not going back down to zero. So it's going to be a lot harder to justify the kind of above a 20 multiple that we're seeing right now. So at some point, the market will have to face some headwinds, but that may not happen for a while. I mean, momentum is a very powerful force.
Matt, when I think of multiples in 2019, I immediately think of the questions we were asking back then, which is tech ultimately too expensive? A question that we haven't really fully gotten rid of in the last 4 to 5 years or so, Matt. Talk to us about when valuations actually do kick in. I mean, do they even matter right now when you're seeing this much momentum, to your point, behind the stock market? To what extent is there a degree of get in or miss out?
Well, there's no question about that. I mean, the fear of missing out, especially for professionals. I mean, for an individual, geez, they miss a rally. Gosh, it's still my money. I'm not going to fire myself. But for professional investors, it's like, hey, if I'm not along for this ride, especially after last year being such a bad one, if I underperform as the market's rallying, people are going to yank their money from me. And so these people have to be in no matter what their outlook is. But at some point, you do think, it's interesting how, we are seeing a few disappointments on the tech side so far. Tesla, even Microsoft was fine, but the stock hasn't rallied much further. So we're starting to get to a point where maybe the tech stock, even tech stocks, are still going to be fine. But maybe some of that new money isn't going to pile into it the way it did back in the spring, because they're much more expensive than they were last spring. So I think you'll see some more rotation into other sectors of the market, which may not push the broad averages a lot higher, but could still have give you some nice outperformance in different groups.
Yeah, and you're already seeing elements of that when it comes to things like breadth, for example. Bloomberg Intelligence, our team there basically did some analysis and said that over half of the global markets are already showing very positive signs of breadth. Matt, talk to us a little bit about, though, that rotation, especially if we're talking about it in the context of the carnage of last year. How much of kind of the bad news, the recession odds, any bad economic data that we get is kind of covered as a catch-all of 2022? What do you think?
Yeah, well, I think that people really look. I mean, again, we're talking about how expensive the stock market has become overall, But a lot of that has to do with that a lot of tech stocks have become extremely expensive. But a lot of other groups are not expensive. I mean, you look at the energy stocks, even though they're starting to bounce back nicely, they're still quite cheap. I mean, they're not as cheap as they were in October of 2020, but they're still many of these stocks are in the market are well below the market multiple. You see the bank stocks again. You need to be a little bit careful on those with especially some of those regional banks. But you see it, J.P. Morgan at 9 times earnings, Bank of America at 8 times earnings. These are stocks that are very, very cheap. And so, people start to look at some of this stuff and say, hey, what's really going to outperform over the last 5 months of the year? Is it the stocks that are really expensive? Or is it going to be some of these names that have actually been lagging now for this year and could actually outperform? I mean, I guess my point is that if you want to buy some value in here, it's going to be tough to chase those big cap tech names, but not so hard to chase some of these cheaper stocks.
Matt, how much does monetary policy matter at a moment when fiscal policy is booming, when an Inflation Reduction Act has injected so much money into the construction sector, into the manufacturing sector? Does monetary policy stand a chance to influence this economy?
Well, it'll be interesting. It will overall, but you make a very good point. I mean, one of the things we all know about fiscal policy is they always, there's a reason why the third and fourth year of presidential cycles do well, is because when they put in new policies towards the beginning of their administrations, they always back end load it, so it kicks into effect in the third and fourth years when they're coming up for re-election. And of course, the Inflation Reduction Bill, in many ways, was really just the Infrastructure Act with a different name to it, and so we're going to see some of this stuff is really starting to kick in now. So again, some of these industrial names and material names should be acting well as that presidential cycle kicks in further as we move into that election year.
Yeah, the election year is going to be fascinating in terms of the, I think, very straightforward trade in the stock market. Matt Maley, thank you as always for joining us bright and early this morning. Coming up on the show, we hear from the Heineken CEO on their week forecast and why the brewer is increasing prices by, get this, double digits. Stick with us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with SoFi CEO Anthony Noto. That coming up at 12:30 p.m. in New York, 5:30 in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London. Kriti Gupta is in New York. Heineken shares are falling this morning after the Dutch brewer cut its earnings forecast on weakening consumption, following double-digit price increases. I spoke to the company's CEO earlier this morning.
We always knew that the first half of the year would be about absorbing the extraordinary input cost inflation that was hitting the company, particularly with our large supply base in Europe. And we deliberately front-loaded the year on pricing, and we always knew that that would have a effect. All in all, we are quite happy with our revenue growth. We are growing our revenue strongly in 3 out of 4 regions. We're having revenue growth between 9 and 10% in Europe, in the Africa, Middle East region, in the Americas region. Actually, we are quite pleased to see that. We see some short-term volume softness, but we do expect that to sequentially improve going into the second half of the year and next year. The APEC region is somewhat different. There, in particular in our imported market, Vietnam, we were hit by a big economic disruption and some more ad hoc things hitting us in the first half. There was a big destocking happening in the first half of the year. We see that now also improving into the second half. Now, underlying the effect of pricing and locking in the revenue growth, we're quite pleased with the quality of the volume. And we don't see down trading. We see across all regions, except for Vietnam, we see premium significantly outperforming our overall volumes. And our flagship brand Heineken actually up 3.7%.
Okay, good morning, Dolph. You say the decline in volumes is all about pricing, and you said you front-loaded the pricing, so therefore you expect less of a kind of a headwind in that regard going to the second half of the year. Across your kind of portfolio, what's the kind of weighted average of the price increase you've made in the first half, can you say, roughly? And are you saying you're basically not expecting any major price increases at all at the second half? Or if you are expecting some, what kind of amounts are we expecting?
Yeah, our revenue per hectoliter, so our average pricing globally was up 12.7%, which, yeah, I think is unprecedented. In Europe, even more, which was notoriously known for very low single-digit annual price increases. We had to take the pricing, and we were glad that we were able to deliver the pricing. Extremely important to protect our gross margins, which already were under pressure due to the COVID disruptions. So we knew we had to do it. We landed the pricing, and particularly in Europe, the volumes are basically in line with our expectations.
The Heineken CEO, Dolf van der Brink, earlier on Bloomberg. Joining us now in Amsterdam is Bloomberg's April Roach. April, Heineken shares down 6% this morning. It's clear the market found plenty to not like in these two key results.
Yes, so Heineken's beer volumes on an organic basis fell more than estimated in the first half of the year. The company also lowered its profit growth guidance for the full year and said it's prioritizing pricing in a bid to offset unprecedented energy cost inflation. It said it raised prices about 13% in that period. And also interesting to note from this morning's report is that Heineken said it's still trying to find a suitable buyer for its businesses in Russia. And it said that it's becoming increasingly more challenging for companies to secure exit approval, and the company took an additional €113 million impairment on this in June.
Yeah, certainly a lot of things going on with the folks who are trying to offload some of their Russian assets. April, talk to us a little bit about what happens in the second half of the year. What kind of guidance did we get? Do we expect things to improve for the company?
Yes, so Heineken is counted on a turnaround in profit in the second half of the year. The Dutch brewer said it expects things to improve with lower pressure from inflation costs. Pricing is also expected to moderate with volumes declining by a low single-digit percentage. And it expects that the bulk of those softening of pricing measures to come in 2024 next year.
April, thank you so much for that. That's Bloomberg's April Roach in Amsterdam. Kriti, when I was speaking to the CEO earlier in the morning, the thing that really stood out to me, we heard a bit of it there, was him saying that consumers haven't traded down in brands, so they're not buying the cheaper things. In fact, to such an extent that they are doubling down on the premium story. They're upping their ad spend by, let's see, I have it somewhere here, 200 million euros, and most of that is going to go towards the premium brands. Maybe it's this sort of shifting to, okay, the whole market, the K-shaped recovery, the ones well off are going to continue to do well off. But again, I think that's an interesting strategy at a time where they're concerned about reaching a tipping point of what consumers are willing to pay.
Yeah, well, Dani, look, let's macro it out here. We're hearing the same thing from a lot of luxury brands around the world, including stateside, some of the tech companies. And yes, Apple, for example, is at the end of the day a luxury brand that if you are investing in advertising, you are confident that a consumer has the money to actually buy the product. It's interesting that even though we're in the markets talking about a soft landing, when it comes to consumer behavior and how a lot of these companies are positioning, they clocked in a soft landing months ago when it comes to this advertising spend.
By the way, Kriti, do you see the latest Apple story from Bloomberg that they're going to try to make their new iPhone 100% screen on the front? I will shatter every single one of those phones. There's no way I should be allowed to have a phone like that.
Look, I'm still getting over not having a fingerprint anymore, so I can't fully digest that change. One thing at a time, Dani.
Oh, I like that. The humble days of a fingerprinted iPhone.
I even miss a good old passcode, you know, back in the day. That was something to discuss in another time. Coming up on the show, a look at some of the market-moving events to watch throughout the week. We're going to go macro and micro. Stick with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London. Kriti Gupta is in New York. Let's get a look now at what's ahead this week for your radar. We get manufacturing PMI data out of the U.S., U.K., France, and Italy on Tuesday. Then services PMIs out of the U.S., U.K., and Europe on Thursday. And then it's another central bank rate decision. The Bank of England rate decision will be followed by Governor Bailey's news conference. Plus, Apple and Amazon report earnings. And then finally, rounding out the week with the U.S. jobs report on Friday. Kriti, we also shouldn't forget about the RBA. Australia also has a rate decision this week. But, I mean, it's likely all going to be about earnings. We get another really big spat of them.
I don't think we can necessarily undermine the possibility of the RBA shaking up markets as well, especially given there's such a commodity-exposed economy. I mean, Dani, just look at what happened with the BOJ in the last 2 sessions or so. I was expecting, I got to say, a bigger read-through into the U.S. markets. Nothing really broke when everyone was saying something would break.
Yeah. To be fair, though, we did see a market that moved off the back of that Nikkei report. I think it's about the nuance of what we actually got from the BOJ, the fact that nothing has actually officially changed in their policy. They still want 0% yields. The band is still 50 basis points. Just how they enforce that up to 1% has changed. And we saw today, by the way, that they stepped in at 60 basis points. You can't actually be certain of where they will come in and buy at this market. So it allows us for maybe a smoother path upwards and not necessarily step changes that would rocket markets.
Yeah, a totally valid point. I think to me what's interesting is the trade and the way that you are starting to see Japanese assets included in portfolios. For example, shorting the JGBs has now become this macro hedge, which was really kind of an in vogue trade, or I would say kind of a newish idea about a year ago. And now a lot more people are invested in that way. So we're, of course, going to be watching the macro throughout this week and the weeks ahead. But let's go to the micro here. Some of the stocks we're watching in the pre-market stateside. The very first one that caught my eye, Dani, was Adobe, because, of course, we've been talking a lot about artificial intelligence and how many people are just kind of throwing money at it versus how many people are actually making money off of it. Well, Morgan Stanley upgrading the stock and saying, look, there is a real roadmap here towards some of the products, some of the AI-enabled products, and that upgrade, that stamp of approval, moving the stock higher by about 2.5%.
I love this because if you look at earnings calls, Kriti, you can see the formula for success. At least corporates think they know the formula for success. So if you look at just the NASDAQ and who's reported earnings so far, references to recession are down 70% this quarter. So more rosy outlook. This won't surprise you. AI, mentions of that this quarter have jumped 43%. You get rewarded for talking about AI. You don't get rewarded for talking about a recession.
But I wonder what the reckoning is at the end of the day. If you keep talking about it now in a couple of cycles, aren't the analysts going to say, well, where was all that return that you promised us? At least that seems to be one of the themes you're going to see in the broader tech space, Dani, which actually segues perfectly into the next stock I'm watching. Salesforce here getting cut, by the way, over at Morgan Stanley. They're saying they're awaiting those further catalysts. So we know Salesforce has been dealing with a lot of different factors, activist interest, for example, their new product line, margin expansion, something that Salesforce, a massive Dow component, by the way, was actually rewarded for. But here they are now, Morgan Stanley off this cut, that stock suffering by about 2%. And Dani, very quickly, I'm going to throw one more at you. Ford in particular, the car makers in focus, also getting a downgrade over at Jefferies. Those shares down by about 1% in the pre-market. The analyst did, however, say he has a heavy heart in doing it, but he says, look, their pullback on the EV story really puts them at a disadvantage. He prefers Stellantis instead, which, as we know from our interview last week, they're really leaning in to the EV space.
I'm sorry, that's really hilarious to cut a stock and say, but it's with a heavy heart. It's a company. It doesn't have emotions. Jefferies, you cut that rating and stick by it.
I guess that's what they're doing. Note given from Dani Burger there. That does it for Early Edition. Surveillance is ahead with Tom, John, and Lisa. Stick with us. This is Bloomberg.